The safest investment strategy in America is also the most popular one. Solid, hard to complain. But international developed markets, as measured by the MSCI EAFE index, returned about 31%. Emerging markets returned about 34%, per millisecond CI data published by the London Company. Both nearly doubled the index that the entire American internet told you was the only thing you'd ever need. Nobody posted about it. Nobody made a victory lap. The money just quietly moved. There is a term for what most American investors are doing right now. Academics call it home bias. According to Vanguard, 2024 Global Equity Diversification Research, the average U.S. investor has about 81% of their equity portfolio in domestic stocks. The U.S. represents about 62% of global equity market capitalization, according to the Morningstar Global Markets Index, but only about 25% of global GDP. That gap between what we own and what the world actually produces is not a rounding error. It is a structural bet, a massive one, and most people do not even know they are making it. Before we go further, I want to be clear about what this is and what it is not. This is an educational breakdown of publicly available data. It is not personalized financial advice. Your situation has unique variables: your income, your tax bracket, your risk tolerance, your timeline, that no video can account for. If anything here makes you want to change your portfolio, talk to a qualified financial professional first. So let us do what nobody in a 15-minute YouTube video ever wants to do. Let us actually interrogate the idea that America always wins. The case for the S&P 500 being the only thing you need is not stupid. It is real. From 2010 through 2024, U.S. large-cap stocks demolished everything else on the planet. Big tech led the way. The FANG stocks turned into the Magnificent Seven. 8 U.S. companies hit market capitalizations measured in trillions. No other country produced anything close. Europe stagnated. Japan was still working through its own lost decades. China's property market was collapsing. Emerging markets went sideways for years. If you held nothing but the S&P 500 during that stretch, you looked like a genius. The data backed it up, the vibes backed it up, and then something happened. The 2nd of April, 2025, Liberation Day, the White House rolled out country-specific tariffs that hit the global economy like a brick through a window. 34% on Chinese goods, 20% on the EU, 46% on Vietnam. Markets panicked, but here is the part that did not fit the narrative. U.S. assets got hit hardest. Treasuries sold off, the dollar dropped, the CIB cratered, and a new trade emerged on trading desks around the world. They called it abusa, anywhere but the USA. Within 12 months of Liberation Day, the Shanghai Composite, the Korean Kospi, and Japan's Nikkei 225 had all outperformed every major U.S. index. According to A.J. Bell analysis published by CNBC in April 2026, Brazil outperformed, the UK outperformed. The dollar index fell about 9.6% in 2025, its worst annual performance since 2017. According to Bloomberg data, global institutional money started moving not out of equities, but out of American equities specifically. And the people who had 81% of their portfolio in one country sat there watching. You opened the app, saw the number, compared it to something you read about European defense stocks or Japanese banks, closed the app. Here is the thing about the S&P 500 dominance story. It is a real story, but it is one chapter in a much longer book. And the chapter right before it tells the opposite story. January 2000 through December 2009, the lost decade. The S&P 500 delivered an annualized total return of roughly -1%. According to Dimensional Fund Advisors, not -1% per month, -1% per year for 10 years. $1,000 invested in the S&P 500 at the start of 2000 was worth about $910 at the end of 2009. During that same decade, international developed markets outperformed. Emerging markets crushed it. Small-cap value stocks outside the U.S. posted annualized returns in the double digits. The investors who had diversified globally did not just survive the lost decade. They came out ahead. But almost nobody talks about it now, because the decade that followed was so dominant for U.S. stocks that it rewired everyone's memory. Recency bias is not just a term from a behavioral finance textbook. It is the architecture of how most people build their retirement. Think of your portfolio like a house with only one load-bearing wall. When that wall is holding, everything feels solid. The rooms are warm. The roof does not leak. But the entire structure depends on that single wall, never cracking. A house built on one wall is not brave. It is fragile. You just cannot tell the difference until the wind changes. And that wall right now is the assumption that U.S. large-cap stocks will continue to outperform the rest of the world indefinitely. Let us look at someone specific. A 29-year-old in Indianapolis, working in claims processing, making $52,000 a year. This person opened a brokerage account in 2020. Every paycheck they put money into one index fund tracking the S&P 500. Total contributions over 5 years, about $30,000. By the end of 2024, the account was sitting at roughly $44,000. They felt good. The strategy was working. Every piece of content they consumed confirmed they were doing the right thing. Then 2025 happened. The S&P still went up. But that international index they had never bought went up almost twice as much. On paper, the gap between what they earned and what they could have earned was thousands of dollars in a single year. Not because they did anything wrong in the conventional sense, but because they only had one wall. That is not a failure of effort. That is a failure of framing. And every platform, every influencer, every default option, in every 401k plan reinforced that frame. Nobody sat them down and said, here is what home bias actually costs over 30 years. Nobody ran the math. So, let us run it. Start with that $52,000 salary. Say this person contributes 10% to a retirement account. That is $5,200 a year. About $433 a month. Over 35 years, at a 7% annualized return, which is roughly the long-run real return of a globally diversified equity portfolio. That account reaches about $780,000 using standard monthly compounding. Now, run the same numbers but assume a return that is 1.5 percentage points lower, which is approximately the drag that pure domestic concentration imposed during the decades. When the U.S. underperformed, at 5.5%, the account reaches about $550,000. The difference is about $230,000. Same person, same contributions, same discipline, same number of years. The only variable that changed is whether the portfolio was built on one wall or four. And this is all public data, public math, not personal advice for anyone's specific situation. But the gap between those two numbers is not theoretical. It is the cost of a framing decision that most people make once and never revisit. By any reasonable standard, the claims processor in Indianapolis is doing everything right. Contributing consistently, living within their means, following the most popular advice on the internet. The system did not fail this person with bad information. It failed them with incomplete information. That is not even the expensive part. Here is where it gets structural. The U.S. stock market is about 62% of global equity market capitalization. According to the Morningstar Global Markets Index, U.S. GDP is about 25% of global GDP. Those two numbers do not have to match exactly. But when one is 2.5 times the other, something is going on. Part of it is legitimate. American companies are genuinely innovative. The legal system protects shareholders. Capital markets are deep and liquid. But part of it is margin expansion, prices rising faster than earnings, valuation multiples stretching beyond what fundamentals justify. And when multiples stretch, they eventually compress, not because of conspiracy, because of arithmetic. A Morningstar analysis published in February 2026 noted that while the U.S. market gained an impressive 17% in 2025, the global ex-US index rose 32%. Emerging markets like Brazil and Mexico were described as offering further upside. Expert forecasts compiled by multiple research firms expected higher returns from non-US equities over the next decade. That one-wall house suddenly does not look so sturdy. Now that wall is cracking, not crumbling, but cracking. And this is the part I want to be precise about. I am not saying US stocks are going to crash. I am not saying international stocks are going to win forever. That is not how any of this works. Markets move in cycles. The US dominated the 2010s, international dominated the 2000s. Before that, Japan dominated the 1980s. No country holds the lead permanently. That is the entire point. The point is not which country to bet on. The point is that betting on any single country is a type of risk that most people do not even register as risk because it has been working. There is a phrase in investing: concentration builds wealth, diversification preserves it. The S&P 500 crowd heard the first half and tuned out the second. Wait. Before you think I am done, there is another layer here that most people miss entirely. After the Supreme Court struck down the Liberation Day tariffs on the 20th of February, 2026, the White House imposed a 10% universal tariff under a different legal authority and then raised it to 15%. According to NBC News reporting, the administration also launched Section 301 investigations into more than a dozen trading partners. According to CNBC, every one of these policy moves injects uncertainty directly into us asset prices. And every institution managing money on behalf of foreign governments, foreign pensions, and foreign sovereign wealth funds is now running comparative analysis across regions in a way they were not doing 3 years ago. Nigel Green, CEO of De Vere Group, one of the world's largest independent financial advisory firms, told CNBC on the 1-year anniversary of Liberation Day that U.S. exceptionalism is still intact. But it is no longer automatic. His words, the U.S. remains central, but it now has to compete a lot harder for capital. Let me say that again. The United States stock market now has to compete for capital. For most of the last 15 years, it did not. Money flowed in on autopilot. That autopilot is off. And here is who benefits from you not knowing this. Every financial product that charges you a fee for us, only exposure has a structural incentive to keep you concentrated. Every platform that defaults your 401k into a single domestic target date fund is making the home bias decision for you before you even understand what home bias is. None of them lose money when you underperform. You do. That is not a service. That is a toll. At your job, at your kitchen table, in your group chat. Someone right now is telling someone else that the S&P 500 is the only thing they will ever need. And the person hearing it is nodding because it sounds right, it sounds safe. It sounds like the thing a smart person would say. 4 out of every 5 American investors are making the same invisible bet on the same single country. Nobody calls it a bet. Everyone calls it a strategy. Now, I am not telling you to do any of this, but here is what exists in the system. Global index funds hold thousands of companies across dozens of countries. The concept is called market cap weighting at the global level. It means owning stocks in proportion to their share of the world's total equity market. It does not require picking countries. It does not require timing which region will win next year. It is the closest thing in investing to admitting you do not know what is coming and building for that uncertainty. The mechanics are not complicated. The decision to look at them is because it means questioning the one piece of advice that the entire American internet agreed on. Performance cycles in equity markets have historically lasted between 7 and 15 years. The U.S. outperformance cycle that began around 2011 is now in its 15th year. That does not guarantee it ends tomorrow. But the person who assumes it never ends is making the same mistake as the person in 2007, who assumed international stocks would always beat the U.S. Both of them confused a cycle for a law. That one wall is still standing. The question is whether your entire financial future should depend on the assumption that it always will.